Ladies and gentlemen, the corona pandemic is a very serious challenge. The coronavirus crisis affects the health systems of OECD countries and actually all countries in the world economy. And unfortunately, it is a negative economic shock which also affects almost all countries in the world, so that we are facing a world recession. We have just seen the latest figures from the IMF World Economic Outlook forecast now in April, and that's a rather bleak picture. So instead of an expected 3% global economic growth, which had been expected a few months ago, the IMF now assumes minus 3% real GDP growth in the world economy. And for instance, the Eurozone will have minus 7% in 2020. Germany actually also roughly minus 7%. Italy might have minus 9%, Spain minus 8%. So these are rather dramatic figures. On the other hand, there is some hope that in the third and fourth quarter we will see already positive growth rates of output, and then a strong recovery in 2021. Countries such as the United Kingdom or the US have a simple policy mix which I think should work, and that is an expansionary fiscal policy coupled with expansionary monetary policy, which means you sharply reduce the interest rates of the central bank. Actually, the interest rate both in the US and in the UK is close to zero in April 2020. And on top, you have quantitative easing, which means that the central banks, so in this case the Bank of England and the Federal Reserve System, they will buy government bonds. So the idea here is that you want to keep the real interest rate very low. You want to have a very low interest rate. You want to anchor this interest rate at a very low level for 2 or 3 years until we have overcome this historical global corona shock. So in the Eurozone, the situation is more difficult. Of course, we have a common central bank, which is the European Central Bank. On the other hand, we do not have anything like a Eurobond. Every country has its own national bond, and so, for instance, German bonds are in the market with very low interest rates. So for a 10-year maturity, the German government pays almost zero, while in Italy the interest rate is higher, and Italy has a certain problem, and that is it has a debt-GDP ratio which was around 130% already in 2019, is now close to 135, and at the end of the year it might well have increased by another 20 percentage points. So there is a risk that we could see a Euro 2 crisis. We have had a Euro crisis 1 in the period 2010 to 2015, and the countries which had been mainly exposed then, that was Greece, Portugal, Ireland, Cyprus, to some extent Spain with its banking crisis. Not so much Italy. Of course, Italy had some problems. You could see that the Italian interest rates would edge up quite a bit. But Italy did not have to ask for any special loans from the EU rescue funds. So this time there is some probability that Italy might lose before the end of 2020 access to international capital markets, and that would be really dramatic. Would be dramatic for Italy, would be dramatic for the whole Eurozone, and the question is how you can avoid this. The governments in the EU before Easter, they have adopted a 500 billion EU loan package, which basically says that there will be 200 billion available from the European Investment Bank for small and medium-sized enterprises, and another 100 billion as a kind of a special loan for national unemployment insurance schemes. And finally, roughly 240 billion or 2% of GDP would be available from the European Stability Mechanism, the ESM, which normally gives loans only with conditionality. So there are special strings attached. You have to undertake certain reforms. And we have seen this previously in the Euro crisis, Greece, for instance, in the case of Greece, Portugal, Ireland, and so on. Now, this is a situation which Italy definitely wants to avoid, and Italy considers its strong exposure at the moment in medical and economic terms in the corona crisis to be an exogenous shock. The Italian government is not directly responsible for this. But on the other hand, the argument you are not responsible for this is not very useful when you need loans in international capital markets. So Italy and Spain and some other EU countries requested that there should be Eurobonds, so there would be basically just all Eurozone countries which would then face the liability as a common burden or challenge, but the German government, the Austrian government, the Dutch government, and Finland, they all said no. And there are some good arguments actually that you would be careful in not simply considering Eurobonds, because it means that you would split liability and democratic responsibility. Normally you have a parliament, let's say in Germany, which decides, okay, we will have a certain deficit. That means new government loans have to be placed in the market at a certain interest rate, and then of course the electorate at the next election could say, okay, that was not a good decision, therefore we will not vote for the government coalition parties, and so there is a political sense of responsibility in this democratic system then. Now, we have no Euro Parliament, that's some problem. On the other hand, I think there are some arguments that one should consider what I call joint Eurobonds, so JABs as an acronym. And the idea is that you would have indeed a joint bond backed by all the Eurozone countries, but there should be, of course, some collateral. I would say 50% would be good if we have 50% collateral from all Eurozone member countries in the form of gold and currency reserves. And it also would be useful to think on which fields one should spend then the money which you get from these loans. And the idea obviously is adequate to have a requirement that, let's say, 50% would be spent on trans-European network projects. So you would have Eurozone public investment, let's say, in railway projects, in high-speed train projects, in electricity, grid modernization, in maybe new airports, in new highways, and so on. That would make sure that we have a use of these additional funds. They could maybe reach up to 5% of GDP within 4 years. That contributes to future growth, and in the case of countries which have had relatively low growth rates in the past 5 years, I think one should also earmark 1/3 for innovation and growth promoting projects. So that would, for instance, apply to Italy. And one could also consider that then the European Central Bank would buy up to 40% of these joint Eurobonds. Final point is that countries such as Italy and Spain, they should consider a levy, a special tax on private net wealth. Private net wealth relative to gross disposable income is in Spain roughly 10, in France it's 8, the ratio in Italy is about 7 and 6 in Germany. So you can have a modest levy of maybe 0.3% over several years, which would then guarantee the payment of the respective interest and principal for these countries. And then one indeed could consider a joint Eurobond in this special construction as a good idea. It would help to avoid a Eurozone 2 crisis. That's very important, and also for the German taxpayers, we would have probably 2% less of a recession. That is, if we would have a Eurozone crisis, then of course the output decline would be much higher. And let's say if we can avoid a 2% additional output decline, that means we actually can also collect 27 billion in additional tax and social security revenues. So there are some good arguments that we should all try to definitely avoid a Eurozone 2 crisis. And if we create a special JEPS fund outside the EU, so just backed by the 19 Eurozone member countries as a multilateral authority, then I think this can really work and would not violate the EU principles. So in Germany and some other countries we have a rather ideological discussion so far, and on the other hand one should also consider the problem that the Italian coalition government already has announced after Easter, and actually on April 14th, that they would refuse to take ESM loans. There is always also fear that this brings some stigmatization effect. You will pay then higher interest rates, and there is also some risk that if there is no adequate solution in this question of the joint Euro bond, then we might see not just a Euro 2 crisis, but we might see Italexit discussions already in autumn 2020. So just after Brexit on January 30, 2020, we would have a debate that a disillusioned and a disillusioned Italian public might vote for leaving the European Union. If such an Italexit would happen, that of course would be a tremendous push for populist votes in Germany's national election in 2021, and one can only warn not to carefully consider the options on the table. We need an arrangement which works, which allows the Eurozone to be as good in its policy mix as the UK and the US. And finally, the Eurozone and the EU respectively, of course, should also contribute to the global economic upswing in 2021. And that's really important because we have the first international economic crisis where the US doesn't provide any leadership. Okay, there's also not much leadership obviously from the EU because it all takes too long to come up with adequate decisions and solutions, but at least the European Union faces a special responsibility in the situation of a global recession to come up with a solution which works in the EU and which gives a positive impulse to the world economy.